motherfucker. Oh, that's beautiful. Mitchin.
fucking cunt. I don't write code, man. God damn. Well, ChatGPT can't fucking write code for you. Oh my gosh. Can I like... I need ChatGPT 4 back because this shit's pissing me off. Is my time limit back yet? Yeah, will it? Will it? Will it? Come on, man. Oh, I need to change this address. It must be greater than the current highest bid. Thank you. Come on, baby. Motherfucker, man. Hit him out. Oh my gosh. The require ended auction thing is fucking gonna drive me crazy. can't I fucking play some business? Come on, man. I've seen when you just fucking gave me, dude. Nothing's different.
So yes, once again, I've been on these a few times now. I think Silicon Valley Bank and Signature Bank is much more of a one-off. That being said, I think I've been clear all along. I'm concerned about commercial real estate. I'm concerned about office building space. But I don't think that is going to be a driving force to recession. I think, yes, we're going to have loan losses, and it's going to be quite concerning, but we have offsets to it that I think is going to be very good.
All right, Robert, let's have the conversation. All right, so, because I think it's so fascinating, because one of the things that you have that I don't have, and I think a lot of other people don't have on the stage, is experience, and you've been through multiple cycles and led large banks through multiple cycles. And so one of the things that's confusing is I never bought into the hyperinflation narrative. I think very few people that knew what they were talking about did. But this other narrative around what's happening with the dollar is hitting a very important level right now. And so, that's one part of the conversation. The other part of the conversation is that we are seeing right now the Fed, in my opinion, working with significantly lagging data, and they're perhaps there are significant risk of overshooting. Inflation has already peaked. Inflation is clearly coming down. Sure, core is coming down slower than top line, but it is coming down. And I think there's a lot of interest in this. Number two, unemployment numbers are not completely what we would call a real number, because there's a bunch of people that are outside of the workforce. And yesterday we were talking about this. Medicaid will end for 10 to 17 million people in May, and so we're going to see the effect of that. I don't think the market is pricing that in. Do you really, Robert, believe that unemployment is not going to rise significantly over the next 6 months?
Okay, so there's a lot to unpack there. But I'll start with, yes, you're right. I have more experience than probably most people on the call. I started on Wall Street when I was 21, and I'm now 62. So I've probably been through every cycle. I may be one of the few on the call that actually has seen real inflation. And most of you who follow me knows that I was very close with Paul Volcker. So I had a very good mentor to help me understand it over my last, near 40 years. So first of all, let me talk about the Fed. When you talk about unemployment going up, if unemployment goes up and it impacts a few million people, yes, that is concerning for hardworking Americans. But we have a social safety net to help those people out, and we can live with that. What we struggle to live with, and why I disagree with you on the Fed, is because when you get hit with inflation, it hits everybody. All 350 million plus people in the country. So when we've been talking about, oh my God, look what's going on in the tech sector. Add up all the tech sector, job losses. Okay, we actually offset those in 2 months of private sector job gains. So when the Fed thinks about their role, which is inflation, unemployment, financial stability, inflation is front and center 1, 2, and 3 when we have unemployment rates below 4%. I think yes, we're way off our peak, no question about that. But we're still running, 4.5%, 5% on inflation, even though the numbers were softer, and even though inflation was better, i.e. lower than expectations this past month.
Let's fucking go, baby.
Energy prices actually have crept up.
Let's fucking go,
geopolitical
dude.
risk. So the softness
6
in
hours
inflation
later.
over the last month may be a one-off a bit. We don't know. But we're still around the 4.5%, 5.5% level. So call it 5% less plus. Their target, which I think they need to change, and I apologize for talking layman, but their target's 2.5%. I think that should change. So they still I think they're going to go another quarter of a point. I think they want the Fed funds rate to stay around 5%. And I think they're still incredibly concerned about inflation. So, I don't think they're going to offshoot. I thought, listen, I'm on TV a bunch. I speak often. I think they were way off on quantitative easing. I think they were way off on calling it transitory. I've been very outspoken. But I have to look at where we are today. And I think where we are today, they should stay the course. And I think they will in May.
Sorry, my mute button. Hunter, did you have a question for Robert? Robert, thanks again. I know you have a hard stop in 7 minutes.
Yeah, I do, and actually it's for Robert because I'm so happy he's on the call because I've been dying to get, based on your experience, Robert, the news that came out that the Swiss Parliament was basically rejecting Credit Suisse. Given your experience, would you enlighten us as to what's actually going on?
That was an all-world trade for UBS. I was on, Mario's call for the first time during that period. And I think I predicted early on that the only real buyer that the Swiss would allow would be UBS. Listen, the Swiss has already done a bailout. For those that don't know, I was overseeing UBS during the Lehman crisis, and we were the first to announce $1 billion loss. We were the first to announce a $10 billion loss. We got help from the Swiss bank. We had what we called a good bank, bad bank. Credit Suisse wasn't going to be able to get a good bank, bad bank because they didn't have the funding we had, i.e. on the liability side with such incredible deposit base and private client base. Not to be long-winded, this is a great deal for UBS. That being said, it's much more of a Bear Stearns type deal where the government did give backstops on the risk, did give funding, and that is not where the governments around the globe want to be. They don't want to be where they're involved in risk management of banks. And therefore, when that happens, it hits taxpayer money. So there is, my guess, a lot of noise in the system in Switzerland about the concern that this is truly a bailout. It's government funded. And I think there's concerns on that. My gut feel is there is no way in hell Switzerland's going to let someone else, oversee that private client base other than UBS. So I think that, this will continue to play out. I think it will be UBS. And I think, I think that Switzerland's not going to allow a non-Swiss partner to come in.
A follow-up question I have to that,
Go ahead,
Robert. I think that's really great. And the question, I've been talking to some senior Swiss bankers, and I'd love to get your perspective, having been at the helm of UBS. UBS's balance sheet in total is something like $1 trillion. Credit Suisse, of course, makes that much bigger. And the Swiss National Bank has had issues. Like last year, they had the worst quarter that they ever had, Q2 2022. And at the end of 2022, their balance sheet was around 950 billion CHF, still a little less than $1 trillion. So, are there concerns? Are there thoughts? Does it not matter that you have a national bank that can't print its own currency because it doesn't have the reserve currency, the Swiss franc, backing, well, quote backing, to some degree, a bank with a balance sheet that's much, much larger now?
Yeah. So, yes, it matters. And that's a great question. Let me just take you back historically. When I was overseeing UBS, we were 2.3 trillion balance sheet. We were the biggest Titanic of the Titanics, unfortunately, and we were 35 times levered. So one, I would tell you the risk capital underpinning UBS's $1 trillion balance sheet today is a much greater capital than it was before. They're probably levered, my guess is 12 times. So one, I would say the risk is much different than where it was, over a decade ago. Number two, their balance sheet is not going to be 1 + 1 = 2. It's going to be 1+1 = no more than 1.5. They will reduce their balance sheet. They will sell assets. They'll have what's called a quasi good bank, bad bank. They're just going to pick off different parts of Credit Suisse. And that's what's going to happen. I mean, Credit Suisse is not going to be taken in its whole entirety. My guess it's going to be part of the private client side, asset management, and a few parts of the investment bank. The rest is going to go by the wayside. So absolutely, this is not going to be a $2 trillion balance sheet for the foreseeable future.
So, Robert, before you head out, I want to make sure that we have a conversation around what happens next. So obviously, you kind of put together the bull case, I would call it, right? That there is not going to be a recession in the traditional sense, not just GDP sense, but actual recession, and that so how are you thinking about the markets in general? How do you think the market's going to obviously the banks are going to make things pop for a little bit, but what are you concerned about? How about that? I know you're not concerned about the larger economy right now. What are you concerned about? What could happen on a macro level that would actually
geopolitical risk 1, 2, and 3 right now. I'm incredibly concerned about geopolitical risk, whether it's what's going on in China and Taiwan, obviously Ukraine and Russia. So one, geopolitical risk for me is front and center. It's why I've been very clear. I think inflation has a longer tail. Number 2 for me, inflation. I'm still concerned about inflation. I think although we've peaked, we're still going to be much higher than where the globe can really afford to be. And then number 3, I don't think we're going to see it, but certainly, when you have half the economists talking recession and half the economists talking inflation, those are 2 shitty bookends. So obviously this whole idea of will we see some sort of stagflation is an incredible nervousness for me. Even if it's a 10% probability, that's 10% higher than I've seen in decades. So yeah, I would say there's nervousness. I mean, I thought today's numbers were good. I was concerned on PNC, right? Their stock got smoked last quarter. So I wanted to see how they did. But PNC is the best of the regional banks.
Exactly.
Right? So I think I have to hop. I apologize. But I think we're going to, and I'll try to hop back on, but I think we should keep all eyes on, like we're saying, what they do with their rainy day funds and how that impacts them. And as we see them take more credit losses. I got to hop. I apologize.
Thanks, Robert. Appreciate you. And by the way, for everybody that's listening, please go down to the comments on the bottom right. There's a I don't know what color people have on non-dark mode, but there's a little bubble on the bottom right where you can comment. We put a poll out on where people's thoughts are about the recession. Are we in a recession already? Are we going to a recession? Yes or no? Please give us your thoughts. I'll also probably put another one about inflation. Has inflation peaked? I think the answer is yes, but don't let me guide you. Tell me what you really think. And so, it's 8:30 Eastern right now. Thank you for joining us, Stock Market News. Evan, can you give us a roundup of where the pre-market is looking? And also bonds. Very interested to hear your thoughts. Evan, are you there?
Yeah, sorry. Connected. Repeat anything. Right now, we have these JP Morgan earnings call going on, so I am pretty focused on that and listening in. We are at the very start of earnings season, so in general, you're going to get the numbers out, and those are important, but what's way, way more important is the commentary from the CEOs and management on the earnings call. So we're really kind of going through all of that for the first time this season, so I'm listening in to JP Morgan, Jamie Dimon especially. There were a lot of quotes out. I don't know what you guys have read out already, and I don't want to kind of go out. The latest I saw was the CFO saying that we don't see ourselves particularly tightening underwriting. And then Jamie Dimon said we still see a rather healthy consumer with excess cash. So there's a couple quotes around that, and I'll let you know if Jamie comes out and says anything. The market, Jamie Dimon is one of the CEOs that the market definitely does listen to more than others. I would say he's probably the most influential banking CEO. When he says something, it obviously is the largest bank, so that does make sense. So definitely keep him on watch, and I'll let you know if he has anything big during this. I did kind of miss your
All right,
specific
great.
question. I might have just dodged around it and just talked about it, but yeah.
Oh, I was just asking about what pre-market looks like right now. I know that JPM is ripping, and I'm assuming PNC is doing great as well. But just wanted to get a sense of where the banking stocks were.
Yeah, so I've been more focused on the numbers than the moves in the market, so I'm looking for that now. But pretty much beats across the board. Even United Health, a little bit outside of it. BlackRock had an in-line on revenue, but more or less, maybe the expectations did come down, and Stock Talk and Jay could talk more to that. But mostly beats across the board this morning, and looks like the market is hot. At least big banks.
Yeah, Stock Talk, what do you think? And I don't know if you heard Robert's commentary about why PNC is the real bellwether for the regionals, but wanted to get your thoughts.
Yeah, I mean, yeah, PNC is a little bit higher quality compared to the other regionals, but I think broadly speaking, we're seeing a bounce in the equities here on banks, and the indexes aren't really exploding in response, which is interesting because the I'm more of an equity focused guy, and there's other perspectives to take on this, but on the equity side of things, it's been difficult to get a sustained rally, even intraday, in the indexes without participation from the banks. And suppression in the price action of banks over the past couple of weeks since the crisis per se. I hate using that word, but whatever you want to call it, the fiasco, the problem, the incident. Since that happened, we've seen a pretty widespread suppression, not only in the activity in regional banks, but even in the bigger banks who were perceived beneficiaries of this once the regional deposit outflow story began to gain steam. But now we're seeing banks, obviously respond pretty positively behind these earnings, especially behind the move in JP Morgan, which is up a whopping 6%. In pre-market, they raised guidance for net interest income to 81 billion from 4 billion, sorry, and I'm sure you guys touched on that already. But now seeing the cap kind of being lifted on some of the large cap banks names, even Wells Fargo up a little bit over 4%, might be the antidote for some of the indecision. But the way the indexes are responding right now, I'm not certain. We'll see how the regular session goes.
Yeah, I don't think it's going to be an antidote, right? I mean, none of this is new. We all expected. We saw the numbers, right? In the first week, there's 67 billion that went to the big banks, and JP Morgan's still paying, less than 10 bips on deposits. So they saw huge NIM expansion. So did Wells Fargo. Wells Fargo saw obviously charges, right? 600 million, and those charges will continue to grow. But the NIM expansion at the big banks is not a surprise. We had that view on PNC. We also were positive on other super regionals. It's the smaller banks that you have to worry about. That's why the market's not participating. Until you see like the mid and small regionals, you see a relief rally there, you're not going to see the market participate.
So from the earnings call, JP Morgan CFO said the deposits in the system are shrinking as a whole due to quantitative tightening. And then Jamie Dimon said that there will inevitably be a recession. Interesting, since Robert was just saying the other, was taking the other side of that bet. A recession may be pushed off a little bit. By the way, U.S. retail sales month-over-month actual -1% just coming out. Forecast.
So I don't understand how you could say there is no recession. I mean, you look at all the leading indicators. You look at PMI, ISM. You see retail sales -1%, which, by the way, unit sales are down a lot more when you take into account inflation. Like real sales are a lot lower.
Yeah. So yes, unit sales are lower. Year over year, also U.S. retail sales actual were 2.94%. I don't know what the forecast was actually, but I don't have that data in front of me. But yes,
it was 0.4%, right? So it missed by 60 basis points.
Jesus. Yeah. So I mean, how anybody can say that we're not in an actual recession? Yeah, you're right, Jay. It was a surprising comment, but again, I think he's always been, even on our space, quite a bull.
It depends on how you define a recession. Are we going to see 2 quarters of negative GDP growth this year? Maybe we won't, simply because when you think about GDP, it's a nominal framework, right? So that means you're including inflation in GDP, right? So if GDP is not negative for 2 quarters, I wouldn't be surprised, but that doesn't mean we're not going to see an earnings recession and a consumer recession.
Interesting. Alan, did you have something? I thought you unmuted.
Yeah, I just reading J.P. Morgan's, the largest item of earnings was what they're defining as interest income.
Yes.
Rose 40%. So just to go back, Robert was not the oldest person in the room. I was at UBS when Robert joined UBS. Robert joined Wall Street in '86. I started in '73. He may have known Volcker, but I lived through Volcker at '81. And I know Jay's involved in the high yield marketplace. I was involved with it in the '80s, as I used to say. I was the only unindicted high yield trader, ran a desk in the '80s. So I have a little bit of a track record here. To go back to what remember Robert is left leaning, so he's definitely Obama-ish and Biden-ish. So you have to take his view on what's going on to be as well as astute and have a long-term meaning. A lot of the politics in there. Just a couple of things here, and Jay, I'd like you to reach out on this. The 10-year Treasury, which I find to be the key barometer of what drives the marketplace, not the bank's earnings because they can fluctuate, but the 10-year bond right now is yielding the spread between the 10-year bond and the German 10-year bond is 111 basis points. A year ago, it was over 200 basis points. So what's happened during that time is European rates have gone from minus 85 to 2%. Ours have gone up, but in the last couple of months, our rates have gone down, and that corresponds with the number of indirect buyers of our U.S. Treasury auction, which is up to around the 67 to 70% of our auctions. Dealers are taking the lowest percentage of auctions that they've ever done. In most cases, under 10%, and the direct buyers filling in the blanks somewhere between 16 and 20%. So what I see here in our Treasury market and what's bringing our Treasury rates down is a flight to quality. My biggest signal in the marketplace was who is doing the buying? Who's actually buying securities? And this is the greatest indicator that you can have. Looking at the auctions, there were 3 auctions this past week, dominated again by indirect buying. So is that a flight to quality? Well, what that does is what you've had that spread contracting between the 10-year bond and the U.S. 10-year Treasury. Also, the euro moved up. And why did that move up? Because now the European rates are yielding at 2% instead of negative. So right now we have a whole bunch of things going on. Bank data, I don't look at the bank numbers. This has become, since I started, and again, Robert should have commented on this. We didn't have a trading desk on our trading desk. We didn't have computers until 1990. So right now you have a social media marketplace, and it's controlling everything. You are looking at headlines. No one's looking under the covers. I don't buy bank bonds because I don't look under the covers. I don't know what's there. They're not taking losses, they're taking reserves. We don't know if those reserves are accurate. This is on the yield to maturity portion of their portfolios. So until you do your deep dive in the banks, I would stick to the sidelines here. PNC is a spectacular bank, and yes, it is a regional bank, and yes, it is a large commercial bank. But I would say that with the trillions of dollars that J.P. Morgan is making on interest income, that's what's going on. Just to give you an example, in 1990, you guys may have heard this, I was at a firm called DLJ, which was bought by Credit Suisse, and we had my high yield inventory was $1 billion. The whole market was 150 billion. The high yield marketplace now is 2 trillion. Is that what it is? 2 trillion? and I
That's
don't
right.
know, and maybe Chief can comment on this.
Other.
I don't think the top two dealers have $1 billion of inventory.
I didn't
When
even
you
mention.
break the high yield
No,
index
they don't
down
take
to
any
the
risk.
three
They don't
components,
take any inventory risk.
I call them waiters. Can I have that order, please? They don't take positions. So part of this liquidity or illiquidity issue that we have in both the treasury market, the corporate bond market, there is no municipal market, no matter what anyone says, okay? And the disorganization, and you have so much concentration, whether it's JP Morgan, Citadel, Veru, or anything else, we have no more broker dealers. And broker dealers were the essence of the marketplace now. And that was caused by the removal of Glass-Steagall in 1998 by what was his name, Clinton, Bill Clinton. But further, it goes back to '86 when Robert joined the marketplace, where the Congress passed the ability for banks to own stocks and brokerage firms. And the banks, and Robert also touched on another thing, leverage at UBS was 35 times. By regulation, the US regulation was 20 times. So the banks, the brokerage firms, that is, so the banks then had to participate in this market to give the brokerage firms more capital. Now, I spent a lot of time not talking about the market, but right about now, a trader has three things, and Jade, stock, you guys can comment on this. Buy them, sell them, or do nothing. The hardest thing is doing nothing. And Robert did touch on one thing. There are global economics, macro situation is just enormous here. And I'm going to ask this question, Ariel, guys, maybe put this out. What do you think is going to happen first? Peace in the Ukraine, China invading Taiwan, or war in the Middle East? Now with the relationship between Saudi Arabia and Iran. Right now, I'm sitting on the sidelines. I'm sitting in bills and shorter term treasuries. I do have some high yield stuff. I do still dabble. But I am, and I do have my golden stocks, my Microsoft, my Apple, my Iridium, things of that nature, okay? But right about now, and you guys can comment on any of those things. I'd like to hear.
Yeah, Jay.
Jay's-
I would love to get your thoughts
Jay,
on geopolitical risk. I will say that the likely answer.
When it comes to the geo, I think that the war in the Middle East isn't really, the state in the Middle East isn't going to change much because of this.
Exactly.
I call it like a pseudo diplomatic relation between Saudi Arabia and Iran. I mean, it's more of like in a beginning of relations than actual relations, and it's therefore economics, so they can control oil supply together. I don't think that it's an actual diplomatic relationship. On China Taiwan, I will reiterate this. I don't think there needs to be a war. I think China basically knows that they control Taiwan.
Everybody's talking their chest.
The biggest landmass across the Taiwanese Strait. They have a big place when it comes to trade. They could blockade Taiwan without even lifting a finger. Taiwan needs to import all its foodstuffs and its textiles and all the ingredients it needs for its biopharmaceuticals and its semiconductor industry. So China effectively controls Taiwan already. So I think that there might be some posturing, but in the end, I don't necessarily think there needs to be a war right now. And when it comes to Ukraine, Russia, I mean, one can only hope and pray that it ends soon, but I don't think it's going to end soon. So there's a risk of inflation and another energy crisis. Sharif Suki, who started LNG Cheniere, he was speaking yesterday. He's a man that I respect because he built Cheniere out of nothing. He's had some difficulty because of, with Tellurian, he built Cheniere at like $600 a ton. With inflation and it being 10 years later, costs have risen so much that he needs to fund this entire LNG project with, a sale leaseback and dilutive equity offerings. So Sharif was basically saying that Europe's going to have another energy crisis because they simply just don't have enough storage for LNG and enough conversion capacity, and renewables aren't going to do shit in a cold winter. So I agree on that third point. that this Russia-Ukraine issue could flare up again unless one of the two parties backs down. In the near term, it doesn't look like one of those two parties is going to back down. So that geo risk is there, and I think there's another risk that we haven't talked about, which is the media risk around this debt ceiling, right? There's going to be an article, in every single paper, every single day, talking about the U.S. default, about not being able to pay U.S. postal workers, even though I think, we're going to pay our debts eventually, right? Because of the bipartisanship in Congress today, if you can't get those guys to agree with each other, or push this to 2024, which would be just kicking the can down the road because that's a political year, this is going to be a big issue for us, right? And that's why you're seeing, alongside some of the other geo risks, why you're seeing gold above $2,000 an ounce, why you saw the miners break out, GLD on the gold front, GDXJ, the junior miners had a great day yesterday, and it's primarily because of that. In 2011, you saw
just one thing, guys. Waller's on the tape. Core inflation not showing much improvement.
Agreed.
Yeah. So yesterday, that was a good point. Yesterday, one of the things that was surprising was that inflation, PPIB in the day before CPIB, but the fact that core inflation is now higher, right, than headline inflation, kind of proves the point where I was saying goods inflation was going negative. Yeah, goods inflation is slowing down, but wages are still sticky. So because of that, the Fed has to continue to hike. And 5.5% rates, it's nothing to laugh at. We have, trillions in corporate debt, government debt, consumer debt. You need to be able to service that debt. And it's not just the $1.5 trillion of commercial real estate that's coming due. You have trillions of corporate debt that's going to start maturing in 2024, 2025. So, it's easy to say, we're not in a recession. When you realize how much interest costs are going up and how much margins are coming down because of interest and because of wages, these companies are going to have a very difficult time, especially in some of the smaller businesses that are not publicly traded, that can't issue stock, or they don't have flexibility where banks don't want to lend to them. So I think it's a very major issue, and you have to wait and see how the smaller banks report, and they're going to struggle to increase their lending.
Yeah. By the way, Jay, can you hear me? Just want to make sure that you can hear me before we keep moving. Otherwise, can we send Jay down and bring him back up? Sorry, stock market news, Evan. Any breaking news or any updates?
Yeah, I was just going to let you know, we have two Fed presidents speaking right now. They've been speaking for a little bit, Fed President Waller and Goolsbee. That's why the market was kind of moving lower. Just one quote from each. Waller came out and said recent data shows that the Fed hasn't made much progress on its inflation goal, and more rate hikes are needed. And then Goolsbee came out and said a mild recession is definitely on the table as a possibility. So a little bit more hawkish on both of them, and the market kind of took it lower. I also saw that the Fed futures were moving more towards more rate hikes than the other way. So interesting to see how the market reacts to all this, but market moving lower off of some Fed presidents speaking.
Perfect. Jay, can you hear me now?
Yes, I have
Maybe.
to
Okay, perfect.
Next.
Yeah. Sounds like your connection is not great. So Patrick, great to have you this morning. How do you think the markets are reacting? And I know your commentary yesterday around looking at the bigger picture. We just had Robert Wolf on stage. And we had a full conversation with him. He is now even more convinced, and I agree with Alan that there might be other factors involved. But he believes that we're not going to see a recession. We are already in a recession, in my opinion. Patrick, would love to get your thoughts.
Well, this is a thing now. In the most recent past, recessions, and you have to look at the market. If you're always waiting for the Fed or whoever decides what a recession is, we know how it is, right? They backfill it, and sometimes they even change whatever their criteria is. Let's say, finally GDP was negative for that quarter. So like in the 2008 recession, like when did they actually say we're in a recession? Because when you look on the charts on their official data, it says a recession started, I think, in like 2007, So what you have to do is you have to look at the charts. You have to look at silver, which is a recovery metal. You have to look at oil. And most of these instruments, especially silver, loves to bottom in the abyss of a recession. So in hindsight, in the future, one day when silver just had its drop to $19 a few months back and it started to recover already, it's possible that in hindsight they will backfill a recession that started a little bit before silver started plummeting its previous drawdown, and they'll say that the recession is on, like they'll probably say we're in a recession, but silver will already be recovering and pricing in the recovery aspect of it. And you could see it also in the US equities going up. So that
Actually, Patrick, one point is everybody was really scared about DXY or the US dollar index. It has made a little bit of a bump off of the low, off the resistance. It's now up 18 basis points. What are your thoughts, Patrick, on that? And then Alan, would love to get your thoughts as well.
Well, the DXY, it behaves like the VIX. It behaves like the gold-silver ratio, which those metals are financialized. Whenever you see the gold-silver ratio spike up, usually it's because gold could be staying flat, going slightly down, but silver is sold off heavily. And again, silver bottoms and is sold off in the abyss of a recession. So if the DXY decides to climb back up, we will have to keep a close eye on the gold-silver ratio. If silver is not able to outperform gold, then that's the markets, the market participants actually telling us that we're in a risk of we are heading into a recession and we're deepening into one. But I would trust way more the behavior of the metals, of the gold-silver ratio, of the DXY than I would any headline news or official people telling us that we're in a recession or not. Because when they tell us, we're most likely already climbing out of it.
Alan, what do you think?
I think it's obvious that you saw, and I look very closely at this spread between the 10-year bond and the 10-year treasury. I don't know what the Dixie is. Dixie to me is a Dixie cup, okay? The only two currencies that really count in this world are the euro and the US dollar. You could throw in the pound, you could throw in the yen. Beyond that, a lot of those currencies don't trade and can be manipulated. So the spread now, where I started talking this morning, was 111. Was 109, up from 102 2 days ago. It's 111. So as that spread widens, more people will go to the dollar. The dollar will have more buyers, and that's what happens.
That's super helpful.
That's
Alan,
reality.
I want you to explain that a little bit more for our audience. That is a very critical point that you were saying. So as the 2-year, 10-year spread,
It has nothing to do with the 2
why
year.
do people go into the dollar? Can you give a little specific? Sorry, we have a lot of people that are looking to learn.
Okay, here it is. The 10-year treasury, okay, let's go back. The German bund was minus 85. The US treasury was 200 basis points higher, okay? So it's trading at 1.5, let's say. Well, at that particular time, the spread was 209, and the euro was, again, at one point challenging parity, right? Everyone was down 102, it's going to break down to below 100. Well, all of a sudden, what happened? Europe raised their interest rates. The compression between the 10-year and the European, the German 10-year bond went positive. Our rates went up, and as our rates went up, theirs continued to track. Now, their rates now are presently 110, 111 basis points behind our rates. But as that spread widens, people in Europe and other countries will buy dollar-denominated securities. And that's been expressed also by the amount of indirect buyers of U.S. treasuries. And I put this forward in my previous comments, that almost 70% of all our auctions are bought by foreign entities. We don't know what they are. They don't define them. So right now, you have this situation. I don't look at the Dixie, only look at the euro and the spread between the 10-year treasury and the 10-year bund. If that continues to widen, the dollar will improve.
Fascinating.
And it's just and this is, okay. I've been following these spreads now since the 80s. And this volatility and our access to data just makes these things much more important. And one other thing about the earnings, everyone's taking up JP Morgan. It said in here that they're profit was up 1% in investment banking. So that means most of their stuff was inflation. Now that goes back to what I touched on, and I guess Jay is probably more currently involved. The talking heads and what people perceive to be reality is not accurate. And data that we get from our federal government and other entities may be misconstrued. So you have to be very careful, be very finite. I like what you said about gold in here. I missed your name, but Patrick was excellent, spot on. But remember, gold and silver are priced in dollars.
So I want to make sure, Alan, I really want to make sure that people understand this bigger macro point that you made. People chase yield. If you can't get yield in Europe, those investors will chase yield in the U.S. There's a
Correct.
There's a gap in yield between the 10-year in Europe, specifically the German bonds, versus the U.S. bonds. They're going to come in, they're going to, quote unquote, invest in America, not because, and this is the beautiful thing about our spaces compared to a lot of other folks, is that we speak very dispassionately because people have got to make money. And this is how the world works. And so ultimately, they're going to chase yield. They're going to come in, invest in American bonds, which then will push the dollar up. Patrick, did you have something to say?
Yes. I was looking actually at the delta. So I did, let's say, the Fed fund rate minus the Euro central bank overnight lending rate, and it's on point. So it's always the delta. So if you overlay the currency, the Euro USD pair, to the Euro central bank minus the Fed fund rate, they track practically the same. But you have to zoom out to see that type of correlation. So yes, the 10-year yields and all the yield curves. If it's getting better in Europe, or they're catching up towards what we have in the States, then the euro will start gaining steam versus the dollar, and vice versa. So the charts are definitely in line with those capital flows as defined by the yields on those currencies, driving the actual price chart of the Dixie, which is primarily, I think, like 58%. It's actually like the Euro USD pair.
Yeah, it's really interesting. That insight, Alan, was great. Neely, I just want to make
sure. One other thing, and Jay made comment on this. You talked about chasing yield, and you're 100%. You're spot on. And right now, people are chasing yield, the high yield 8% yields. One thing they failed to realize is that almost 800 issues in that index, which is 2,000 issues, are triple C, which are trading above 13%. And chasing that 13% correlates to the default risk that Jay mentioned. So you're 100 points spot on. They're buying yield, they're buying risk. They moved away from the SPACs. They're looking for other things to buy. And Jay, can you comment on the spread between the double B, single B, and triple C in the index, high yield index?
Yeah, Jay, what are your thoughts on that?
Sure. I mean, the spread between the double Bs and triple Bs, and basically just the high yield spread itself, you can actually.
Jay, can you also explain to folks what we're talking about?
Sure. Right. So a high yield bond is essentially a bond where you have a rating below triple B minus or Baa3 by S&P and Moody's. And, it's over $1 trillion market. You also have a high yield loan market, which is over $1.3 trillion. And then you have a private debt market, which is $1.5 trillion. So you have about $5 trillion in leveraged capital markets, for mid to large size companies in the United States. These are companies that are having trouble issuing bonds right now because of how high rates are. And the market tends to look at high yield spreads because high yield spreads estimate a probability of default less recovery. So, that spread, that premium, compensates the investor for illiquidity risk and for default risk. And when spreads are going up, it means that the market is pricing in a higher probability of default, which is also a leading indicator for unemployment, because when you see higher defaults, you see more layoffs, which is why the Fed focuses on this. The spread, in the high yield market, really peaked out last summer, where you saw high yield spreads, kind of gap up. And what we've seen is they've compressed relative to where we were at the peak of last summer. And we don't feel that if we enter a recession in 2024 or at the end of 2023, that high yield spreads are compensating investors enough for default rates increasing. And that's something important to understand. Most of the yield in high yield is coming from the rate aspect, because high yield spreads are on top of the U.S. Treasury yield. So if you have a five-year bond and five-year Treasury, and more than half of your yield right now is coming from the risk-free rate for the Treasury, and a smaller amount is coming from the spread. What was mentioned is that investors are taking too much risk chasing yield. In fact, I've seen in my career, retirees tend to lose the most money, chasing 13, 14, 15% yields, not understanding that the risks that they're taking when they're buying those types of bonds are magnitudes higher, right? Like 20, 30 times higher than buying a bond, with a 6% yield. So, there's going to be a misallocation of capital, because right now the market, there are people who think that we're not entering an economic slowdown, and they're buying risky bonds. They're buying single B bonds. And, there's going to be a huge downgrade cycle like we saw, not as fast as 2020, but when you enter an economic slowdown, you see downgrades accelerate, and that forces I'll give you two perspectives. On the loan side, it forces forced selling, because 80% of the loans in the United States are actually not owned by banks. They're owned by collateralized loan obligations, CLOs. And they have these ratings buckets where if you have triple C's over 7.5%, when a single B is downgraded, it becomes a triple C. And when your buckets go above 7.5%, all of a sudden you're forced to sell those bonds or mark them. And it's a very difficult position to be in, and it shuts down the loan market. Same thing in the bond market, right? There are forced sellers like insurance companies that can't own a significant percentage of high yield bonds. So and specific mutual funds that can only own IG bonds. So the single B market is the biggest it's been relative to the total high yield market. So if you see even a soft recession, you could see the number of triple C's jump pretty materially. And you could also see, a number of triple B bonds go to double B from investment grade to high yield, and you could see forced selling, and that could shut down the high yield bond market. When the high yield bond market and the loan market are shut down, companies can't refinance their debt. That's when defaults go up. So
And that's scary.
I'm not in front of my computer right now, so I can't give you the exact spreads.
One thing I wanted to circle back on, and this is a bit of a pivot, but I know we have Neely here just briefly before she has to run, so I wanted to get her to touch on this. But we got retail sales this morning as well. I pinned it at the top, printed -1% month over month versus -0.4% expected. So pretty big miss there. But Neely, I'd love to get your thoughts just generally on retail sales as well.
Thanks, Stock Talk. And I wanted to hop up because this is a big mess. It's not just a big mess on the month over month number, but if you just look at the deceleration and even some of the categories, we track this. There's nearly 70 categories, and we track it broadly. So I would say just on a year-over-year basis, unadjusted, which is the way that retailers will typically look at it, because that's what really happened, and that's actually how they budget. It was up 3.1% in March, a massive deceleration from 6.1% in February, and a further deceleration from January's 8%. So you've gone from high single to low single in just 2 months' time. That is a big issue as it relates to planning. It's the slope of the decline that concerns us. But when you look at some of the categories behind the scenes, it gets even a little bit more confirming to our broader thesis around what's going on with SNAP benefits and tax refunds. General merchandisers in February, they were up. This is think of it as the Targets, the Walmarts, the department stores, the dollar stores, right? That sort of category. They were up 10.9% in February. They were up only 2.9% in March. So that is a massive deceleration from 1 month to the next, and certainly would be concerning us as it relates to the profitability of the sector overall. So,
what is the hypothesis here, Neely? What is the cause?
Well, as we mentioned yesterday, we're concerned that the consumer's capacity to spend has been challenged. So you have SNAP benefits rolled over, 40 million plus people. Remember, we talked about the healthcare dynamic, people losing healthcare potentially, some concerns about that. You also have tax refund dollars. We're down close to 20% year over year. The total economies, the tax refund dollars in total, were down 20%ish for the month of March. So that is that's less money in people's pockets.
I'm trying to get you to say the words I want to hear. Consumer is not as strong as everyone pretended.
Right.
That's what I'm trying to get.
This is why the whole recession argument made no sense earlier.
Exactly.
There isn't a recession. Of course, there's a slowdown.
And I think the importance of on retail sales, of course, we're data nerds, is that this is data reported by businesses. There's a lot of government data that's reported by people, which is a little bit less reliable because it's like, how are people feeling? Do they actually fill out the form? Did they include tax and tip on whether or not they said their restaurant sales? Right?
Is there selection bias?
Correct. And you know, like I've never filled one out because I won't take the time to do it. Right. However, businesses are required to fill out these forms. They were required to report them into the Census Bureau. And so retail sales is a sturdy set of data and something that needs to be contended to. And it is representative of the goods side of the economy, not the services side, broadly speaking. But, you know, this is by the way, including inflation. So it's a problem that it's decelerated so much. We haven't seen these levels. I went back and looked at our data. We haven't seen these levels in absolute basis since like late 2020, early 21 in terms of the overall retail sales number. This is a big deceleration.
And Neely, you just said a good caveat. The other side of the coin would say that services has perhaps made up for goods, right? I mean, we know that people stock up on goods, but
yeah, and it's about 50-50 right now in the economy. You have about, you know, historically prior to pandemic, we were about 40% goods, 60% or so services. We're now, and these are just rough numbers, but we're now closer to like that 50-50 mark. So it is only about half of the consumption piece.
Exactly. Piotr, did you have a question? I know you had a question about the euro-dollar dynamics.
Yeah, hey man. I don't want to disrupt the flow if you guys are mainly focusing on real estate and one specific theme, but I do have a question, a point.
Go ahead.
No, I just thought it was quite interesting the geoeconomic dynamics of Macron's visit to China and what that has been doing to obviously comments around the EU as a strategical pole and what that's been doing to the euro and the markets in the European continent in the past couple of days, because we've seen sort of obviously damage control trying to be done, and the US has been pretty hawkish on the comments versus other comments from the Europeans, which have actually been more tacitly endorsing his comments. So I was just wondering, for those who were talking about the US dollar versus euro dynamics, if they had any thoughts on those implications, the political risk element to it. And if that could potentially play out in the case of the remini and broader dynamics in Asia as well. Cheers.
Yeah, Alan or Jay, do you guys have any comments about what's going on with the euro? And sorry.
Sure.
Yeah, go ahead, Jay.
Yeah, that makes sense. So you have an environment right now where people think that the U.S. is going to slow the pace of hiking, while in the Eurozone, it looks like they're going to continue, and that perception of a change in interest rate differential is negative for the dollar versus the euro in the short term. Just like in the prior year, while the US was hiking much faster than Europe, the euro was collapsing versus the US dollar, and there was also some risk in Europe because of what was going on in Russia, Ukraine. So, you know, this is kind of just a mean reversion, what you're seeing, and European growth has been stronger than many expected because Mother Nature was very kind, and we didn't have a cold winter, and they didn't have the big energy crisis that we expected. You know, even today, there are over 5 very large agricultural fertilizer factories shut down in Europe. Like, there are steel mills and aluminum smelters that are down in Europe. Like, the economy was under threat. Like, they could have shut down 20% of the economy if you had an energy crisis. And you know, luckily they didn't have to deal with that. I think that, you know, there's another risk of that this winter, but the euro differential, if that's your question, if I heard it right, is because of a perceived change in the first derivative of interest rates, and also because of the fact that their economy is doing a little bit better, and Europe benefits from a China recovery, right? They sell luxury goods, you sell LVMH. You know, Europe is set to benefit more than the U.S. from a Chinese recovery.
Yeah, and I think the big question though is, Jay, with all of this money flowing into the dollar potentially with this differential, what happens to Europe? Do we
And
see?
can I just tag on to that very quickly? Just what's your take on the IMF forecasts from the past couple of days? I think they revised the US economy up. Generally, they're looking quite buoyed for the European continent. I mean, the UK's screwed, obviously, but just curious for your take on those projections more broadly. Thanks.
Yeah. So I really don't pay much attention to those.
Exactly.
I think those projections usually are wrong. I tend not to focus on them as much. I agree that the UK is not in a very good spot. I think that as long as we don't have an energy collapse, I think that Europe is in a much better spot than they were last year. I think that the US, while we may not see negative GDP 2 quarters in a row, especially this quarter, we will see a material slowdown in consumer spending for the reasons that we discussed yesterday and that Neely's discussed. I mean, you're already seeing it in the retail sales. I think you're also going to see an earnings recession. The big banks that you saw today, why did the market sell off after the rally pre-market? After JP Morgan reported and BlackRock reported and Wells Fargo and Citi reported. The big banks were always going to be, right? If you have a checking account at Chase is paying you nothing and interest rates are at 5%. Of course it's going to make trillions of dollars in net interest margin, right? Same thing with Wells Fargo, same thing with Citi. When you need to see some of these smaller companies report in the second half of earnings season and see how much they're suffering from margin compression and what their outlooks are. And I think that could turn a lot of people's heads. And if we do have an earnings recession, right, it's going to be very difficult for the market to have any legs, right, above 4,200. So that's kind of how we're thinking about it. For the European market has exceeded, right, the performance of the U.S. market because the banking concerns have primarily been in the U.S. And for the last 15 years, the U.S. market has outperformed the European market on almost every metric. This is a period of time where it makes sense, right, given the P differential, given relative, growth dynamic and outlook, for the European market to do a little bit better in the short term. So, hopefully that addresses the question that you had.
Yeah, there's another point here that I want to make. When you start looking at forecasters, whether they're economists, whether they're analysts, and sorry, Neely, this does not reflect to you. Someone just brought up the point that JP Morgan exceeded the analyst expectations. And last quarter, companies beat the analyst expectations by 71%. Now, I'm going to turn that around. That means that the analysts were wrong 71% of the time. Okay? So if anyone thinks that analysts and economic forecasters are infallible, they have a very, very large problem. The other thing that is interesting on the France-China thing, well, we know that France will flip-flop at anything and always run to the strongest power, which upsets me the most. That if France is kowtowing and Brazil is kowtowing to China, it shows that maybe the U.S. is not as strong as everyone, or the leadership, let's leave it at that, is not as strong and is not as strong as they can be. Neely made some great points, and Jay.
But Alan, is it the leadership, or is it just that they're doing more business with China, right? I would think, from an economic perspective, right, that France is just doing a lot of business with China, and China imports 60% of the world's commodities, right? So Brazil, their biggest customer is China. So just logically, from an economic, expediency perspective, I think it makes more sense for them to, be nicer to China simply because they're earning more revenue.
Oh, you're 100% right, but when is the U.S. going to wake up and smell the coffee? I posted this in Twitter, and 90% of all generic medications consumed in the United States and in the world are produced in China, India, and Brazil. And that used to be a flip-flop in 1998, okay? So now, unless we start bringing, and that's why this chip progress thing and building chip plants in the United States, building rare earth manufacturing in the United States, bringing more things back to the United States upsets China just about more than anything else. Because unless we grow our economy, and they're just not consumers, I ask this question all the time. Is Apple a Chinese company or American company? Well, it's made in China and consumed in the United States. So,
But,
you know,
but we
that's
own
what
the IP, or at least the IP is in Ireland.
Exactly.
We own the
and
IP,
also,
and not only that, I think they moved 7% of their assembly to India, and they're moving the MacBook production to Thailand.
Well, hold on, wait a second. Why didn't they move it to someplace in the United States, which would benefit the United States?
Consumers
Just wages. Wages are
They're
too
making
high.
so much, they're making so much money. It's a give back thing, guys. That's part of the problem. I'm a 1963 since liberal. Okay, you don't have to make for that money.
We need to find a way to bring these companies back to the U.S., but there has to be a financial case for it. It can't just be a governmental case. But I was going to say that
Well, but we can't. Let's just 1 second on that. Okay, I'm not talking about a financial thing here. I'm saying about you can't. You know, someone once said to me, "Well, we can't bring it back here because it's the shareholders to make money, right?" Okay, but these companies, Apple would not have grown if they hadn't been in the United States. So there's got to be
which is why the intellectual property is kept in the United States.
Yes, so why don't we bring back some of that revenue and take it? What's the town in Oakland? Build a plant in Oakland, California, where they have huge amount of violence, huge amount of unemployment, where the people's hands in Oakland are not any bigger than they are in China or India.
That sounds like a great campaign slogan, but people
Well, I
will be
mean,
really
we have
mad when their iPhones cost $5,000.
We have 3.5% unemployment, and I mean, you don't want your son or daughter like gluing small transistors onto a circuit board, right? Like that's not the type of work
that's not. You remember what Robert said? He brought out a point which showed his left leaning and said, "We have a social safety network, which will help people in the times of a recession," and that's my concern right here. We have more people that aren't working that are collecting government subsidies, and we have to figure a way to get that done. I don't know.
Well, Alan, maybe this is. I mean, I think this is awful. This is going to happen, but you know, a bunch of people are going to get kicked off of Medicaid, and so as a bunch of people get kicked off of Medicaid, they will be forced to go into our sort of barbaric health system where they have to get access to healthcare through their employer, which I think is completely nuts. Alan, you know, if you have access to Medicare, perhaps most people in this country should have access to a safety net. I'm not gonna, again, and just so everybody knows, I'm actually very right-leaning, but when it comes to healthcare, that should be a right. All right, so let's keep moving on. I want to move forward. You know, manufacturing numbers in. Kind of interestingly, actual came in negative 0.5%. The market expectation was negative 0.1%. Previous, for people that don't know, was 0.6%. Manufacturing numbers came in pretty bad. As a reminder of what Alan is saying. And so, you know, as we start wrapping up the space, would love to get people's thoughts on what are you looking at today, and what, you know, obviously geopolitical risk is high. I'm actually not convinced that it's as high as people think it is. I just don't think anything is going to happen. And I will tell you, I think the Russia-Ukraine war is going to go on forever, or for a long time. I think China is not going to do anything in Taiwan. You know, this is just people puffing their chest. And I think that ultimately, you know, the Middle East, I don't know if people know this, but that problem's been going on for a while. It always looks like it's going to bubble up, but it never does. There's just too many entrenched interests here. So, you know.
And economically speaking, I think that there is a very interesting power vacuum being created, and like the increased relation between geopolitical actions and, let's say, market participation is actually increasing, especially within, let's say, euro demand for US dollars. To your point, macro being down there has been talking about that quite a lot, specifically with currency swaps and other forms of derivative products that necessarily illustrate the demand needs for the let's say, euro structure or eurozone in relation to, let's say, the United States. What I find fairly interesting in this development is essentially we are seeing this power vacuum, and it won't necessarily mitigate itself anytime soon, right?
Exactly, and ultimately, I will say it might be time again for us to take a victory lap around the fact that China is not going to be the global reserve currency. The U.S. is not getting hyperinflated, and everything is going to be just fine. I think we have much bigger things to worry about in the long run. In my opinion, it's a deep recession. I honestly, I'm a little bit in shock to Robert's commentaries that we won't have a recession at all. I'm not sure if that's what he meant to say, and he said it in that way. But I think it's kind of interesting that that was his initial point. But even beyond that, I think that what we're most worried about, in my opinion, right now, is deflation. Seems like deflation is going to be managed
I don't need the
possibly by
whole
just the
fucking
global
thing. God
economy.
damn.
But the biggest risk to the U.S. right now is deflation. Has anybody been watching the crypto markets? Can someone give us a crypto market roundup?
Yeah, there's not much of a roundup. It kind of mostly has gone sideways. I mean, it was up, on the news of J.P. Morgan of about 2% this morning, starting from when banks' earnings calls happened. So, not decoupled yet, but all the calls for crypto being decoupled from high beta stocks has not yet occurred. But yeah, I think it's largely unrelated. It's mostly sideways.
Yeah, I mean, it's fascinating that people are so worried about that.
It's up 0.9%, 0.9%.
Sorry, go ahead.
I kind of do want to bring up one of the things is, I think there was a comment earlier about kind of euro and how it's trading. I thought that discussion was fascinating with Alan and some other folks.
One other point I forgot to bring up with Jay. The amount of euro defaults that are taking place with higher interest rates and restructurings has gone up significantly. I'm seeing at least one or two a day. What do you think about on that, Jay?
I mean, I think the number of defaults we've seen this year is the highest it's been since the first and second quarter of 2020. And that is not something to be taken very lightly. And what that means is, when a company defaults, it files Chapter 11 bankruptcy in the United States, or in a lesser case, Chapter 7 liquidation. There have been a number of companies, like recently you saw Tupperware, which is a household name, announce that it was not a going concern, which means it's going to file for bankruptcy soon, right? You have Bed Bath & Beyond, which is like on the brink. You have AMC that needs to restructure, right? There are going to be companies that you know, Party City, like there are going to be a number of companies that with brands that that are simply going to go away, right? Or find themselves under new management, new sponsorship. So, this is something that I know the Fed is looking at. It's not really covered as much in financial media because these are usually smaller companies. The bigger companies, especially during COVID, they extended their maturities out. They refinanced their debt, just like you refinance your mortgage, and they pushed it out. So you're not going to see huge companies, but you're going to see hundreds of small and mid-sized companies go bankrupt over the next several months, simply because of where interest rates are and the slowing economy. So I do think it's material. You're going to see more of that, I think, in 2024 and 2025, unless we get interest rates lower.
I mean, the other thing to add to that is, of course, the VC market, or rather, the market for startups is, as someone pointed out, much, much smaller. But I mean, we're going to see some similar things happening there. And unlike some small businesses,
Eugene, can you explain what you mean? Can you explain what you mean exactly? Are you talking about the European VC market, or are you talking about the VC market in general?
No, I'm mostly talking not even about the American VC market, but the Bay Area VC market, which is substantially the greatest portion of the VC market. So obviously a very localized market.
And Eugene, let's put it in context a little bit, since we're both in tech. We know way too much about this. But for people that are not aware, this has been the least active VC market since like 2019. The first quarter has been essentially everybody sitting on the sidelines, collecting management fees. Eugene, keep going. Sorry, just want to make sure that people understand. There's been a significant drop-off in activity.
Yeah, absolutely. And I'd say there was a joke, and we're in these WhatsApp groups when we were chatting about how we were talking about, hey, maybe we should do a VC roundup, a VC deals roundup. But actually, it's kind of like, well, VC activity these days is really just VC AI activity. It's almost like a tautology, right? I mean, I think AI is the only sector which actually should give some, bright spots. But you have VCs basically looking for AI deals. I was on an AI investing panel just yesterday here in New York City where I'm visiting, and I was at GDC where it was all about AI, generative AI, and the big questions around where do you have moats, et cetera. But not to get too deep down the startup rabbit hole. But as a former VC, as someone who's been investing for quite some time, it is. It's dark. I'll say. The numbers show it, but also just the sort of sentiment in the Bay Area. I think you're seeing a lot of VCs pulling back, and a lot of founders have a lot of anxiety to raise lots of money, put most of that in Silicon Valley Bank, and we saw how that turned out. I think there's just anxiety about how their next capital raises are going to occur.
Actually, what we're seeing in the venture capital market, I'm going to talk from the limited. So for people that don't know how VCs work, venture capital, they invest in startups, but they don't actually put their own money. They actually represent the money from pensions and endowments. So they're actually taking other people's money, taking a management fee off of it, and then investing in startups. So they're taking the management fee because they're doing due diligence, they're sourcing, they're helping portfolio companies. I'm not trying to imply they're not doing anything. They're actually doing a ton of work compared to a lot of other people that take management fees. But the business of VC is to invest in startups. So when they're not investing in startups, they're not doing anything. And so they're only helping their existing portfolio companies. Going back to the limited partners, with equities, which is the public stock market and other things, coming down so quickly, and with there being risk-free money available in the bonds market, limited partners have been unwilling to take markdowns to get liquidity so that they can push it into the VC market. So actually the venture capitalists have not been willing to make investments because they don't want to ask their investors for money. Because for their investors to put money in this asset class, it's called the denominator effect. And so we've seen this right now. But with equities making such a huge bounce back, the big question that I want to pose is, are we going to see, I know Jay probably doesn't think we are. I remember Jay, a couple of weeks ago, you said that this is going to be VC market. Patrick, I'm gonna meet you here, my friend. The VC market is going to have a pretty big hit, especially with Silicon Valley Bank. But the question really is, with now the banks seeming to have stabilized, and for people that don't know, Lux Capital just announced another $1 billion fund yesterday. So there has been a flight to quality for the limited partner class. They're going after the biggest funds and giving more money to them. Just a broader question around the financial sector, especially when it comes to the innovation financial sector, to Eugene's point, are we going to see a resurgence of venture capital, or are we still going to see people be very careful for alt assets and so on? And David,
extreme caution, extreme caution. And the statements that we were saying, especially when, let's say, environments of low rates leading into higher rates creates this actual impetus for participants to try to search for yield, whether it's risk-free yield, or in that sense, it creates this form of, let's say, complexities within the lack of solvencies within the market. Long story short, I don't think that we're going to be seeing the cost of capital mitigate itself anytime soon. And by cost of capital increasing, we're going to see the fluidities of credit and credit compression, as Jay has been talking about throughout the whole space, fairly high. And so once this credit compression cycle is over, then we can actually presume that a lower rate environment coming into play, that we could see more credit acquisitions and credit activity. But until that point, we won't have any fluidity. And this is where it's very important, because credit utility, right, debt to GDP is a very important factor, in the sense that debt to GDP since 1971 has had a pre-deposit, specifically in the utility of debt within your lower demographic or student loan type demographic. And when we increase their debt utility, it by virtue is going to increase the GDP by employing them in any redundant job that the actual economy could offer, whether you're working at McDonald's, yields or you're working within your actual inclined field, it's irrelevant because you're actually producing the same debt to GDP as you pre-deposited within your actual acquisition of that credit. But on that point, I do have a meeting to jump in at 9:45, so I will be dropping off. Thank you very much, Dr.
Thanks,
Danish.
David.
Thanks,
Jay,
David.
what do you think? Is the VC market frozen for a long time?
Maybe
Could
we'll
I
get
take
Jay.
that? Can
No,
I
no, I'll
take?
get Jay.
I'll
I
take
wanted
that.
to jump in.
I'll
And
take.
what?
I'll take that for a second.
Go for it, Alan.
Yes, and remember what I said about bonds. People are going to Treasury for flight to quality, and I think, and that's the inverse. People are moving away from the riskier assets. Okay, and so I would say that VC marketplace, and it can explode at any time if there's a new invention or something like that, or the biotech market could do anything, or the gold market could roll up, or silver could roll up, or oil could move up. These things are spontaneous, so you have to be very careful. But here you go, Boeing down 2.6% after pausing 737 MAX deliveries. That just came out a couple minutes ago. So I want to throw that out here. Yeah, you have to be very careful here, guys. That's that's my warning. And you know, just be the problem. You know, growing up in the early '70s when we had high inflation, and then the Fed did their mumbo jumbo and reduced rates, and with the in 9 years after, well, let's say 8 years after that, we had 21% short-term rates when Volcker came and ripped up the playbook. So you have to be very careful here. I don't know if we're going to stagflation, but I know we're in some kind of recession. I don't know if it's classic recession, but interest rates at 5% are not high, because when I grew up, they were 8, 9, 10%.
Yeah, definitely, undoubtedly so, and that's going to, of course, affect rates. Will have a big effect on how VCs both raise and deploy capital. Final point related to banking, actually, on the VC side. You know, during rolling back to the crisis of SVB several weeks back, the biggest demand for as we were all trying to get out of it, Silicon Valley Bank, JP Morgan was like the gold standard, right? Everyone was trying to either get back to the relationship with our JP Morgan bankers. We were lucky to have that previous relationship, and everyone else was asking for our relationships for that. And that's kind of anecdotal, but and the other thing is, it's not like the tech market for startups is like a gigantic portion of GDP, and eventually becomes so. At least our research shows that it's about VC-backed companies become about 20% of U.S. GDP eventually. But the way they are now, it's of course a small portion. But a lot of the flight to quality to the big banks, which is why I think we weren't surprised, was this. I mean, when all your money's gone and you're trying to figure out where to go, the big money center banks, of course, look very attractive, and specifically it was J.P. Morgan, right? So interesting to see the kind of that news reflected this morning, given the sort of desires that people had just mere weeks back. So that's one thing to think about. I do kind of the positive note, despite there being kind of doom and gloom. Again, for years people were anxious about the fact that China had a huge advantage on the U.S. On AI, right? Because the AI training data they had on their 1.5+ billion population meant they had much better data, for example, like facial tracking, et cetera, on AI. But I think OpenAI and ChatGPT, et cetera, are showing, and specifically not even Bay Area, like there's Hayes Valley now in San Francisco is called Cerebral Valley, right? So I guess if the counterpoint to the doom and gloom is the AI market is extremely strong in the U.S. and is a huge bright spot, not just I think for VC and tech, but for the U.S. in general, right? If you look at the leaders, it's like the U.S. way on top, China kind of way below, and then kind of nobody else. So if you're a U.S. tech fan or just even a U.S. citizen, I think that's a cause for celebration to some degree.
It's fascinating, and on that positive note, I want to thank everybody that's on stage, everybody that's listening down there. We're going to close up the spaces, and remember, every day at 8 a.m. Eastern, we get started and give you the market roundup. We are not going to be on for the weekend, but at least not this weekend. But if you guys have ideas for different guests or different people, feel free to reach out to Mario or myself, and we would love to hear your feedback. And thanks again, everybody. This is the first week, so it has been kind of insane. So really appreciate everybody joining us. Have a wonderful day.
Just one quick thing. So, when it comes to rates, I think you really need to keep in mind that rates are relative to the amount of debt you have. right? So if you have $100 of debt, you can pay 10% interest and it doesn't affect your pocket. You have, 31 trillion of debt, and all of a sudden, every 1% increase in the amount of debt that we face as the US government, given that half our debt is going to mature in 3 years, is 400 billion of additional interest that we need to pay as taxpayers, either by raising taxes or cutting spending. We all know we don't cut spending in the United States, or we should, but we don't. So I think that it's a much different space that we are in today, and the shadow lending market is about a 90 trillion market. You think about how leveraged our corporations and our consumers are. I think once we get to if we got to 6%, you would see mass bankruptcies across commercial real estate, corporates.
Yeah, I was trying to end on a positive note. Jesus Christ.
No, I mean it is a positive. It is a positive.
That's very positive. It is positive. It's only 3 years, right, Jay?
Yeah. So no, it's positive in that if you can understand this, you'll realize why we're not gonna see 10% rates. We're not gonna see. I don't think we're gonna see anything above 6%. But in terms of topics, I think earnings season is going to be really interesting. I think 42%, 24% of companies are reporting next week, and then the week at the end of May, there's 1 week where 42% of companies are reporting in 1 week. So it's going to be absolutely bananas. By the middle of May, I expect a lot more volatility because the number of companies reporting is going to be 2 to 5% per week, and people are going to be more focused on macro again. But this is going to be one of the most interesting earnings seasons you've seen, because you're going to see a number of companies change their guidance. And I think last year, like 62% of CEOs said that when they mentioned the word recession or slowdown in their earnings call, you're going to see like 80% of them say it this time, and maybe this time they actually take their sales guidance down.
Jay, what percent of analysts are going to be wrong in their forecasts?
90%. 90%. They're always wrong. I mean, it's just a game. And then the analysts covering companies for 10, 20 years, they're no longer working at the banks. They're either have their own firms, their own family office, or they're working at a fund. It's the analysts that are covering these companies. Some of them have only been covering them for like 1 or 2 years, especially some of the smaller cap companies. When I call them, like, how long have you been covering the company? Oh yeah, I just picked up coverage. My analyst was let go, during COVID or whatever. So it's not a very accurate. We look at consensus, which is a broad average, right? Just to get the reason why it's even in the ballpark is they're getting most of their information from management teams. They call management tells them where they think earnings are going to be, and then they write it down. Most of them don't have their own opinions. So, they tend to be lagging. That's why you see analyst stock prices. They follow the stock price lower or higher. They never predict it. They're always like, if the stock price jumps up 100%, they take their estimate up. The stock price falls 50%, they take their estimate down. That's how most of Wall Street works. There are obviously some good analysts.
Absolutely. All right. Well, appreciate you all. Thanks for joining us. See you all Monday. Follow the hosts. See you guys.
Many faces. All right. What's the stream at? No views. We've almost been going for 3 hours again. Okay, I gotta take a break real quick, so be right back.
Everything has been good. This is my second time talking to you. We had one call last year. Just a little bit of context. And I'm actually in a family business who my parents are running. So right now, I'm conflicted between. I love my parents a lot, but I'm conflicted between like my parents is being very unhappy and always arguing about like business problems, and they are always bringing it home. And sometimes I'm confused between what I think is best for the company, like my operation wise or whatever. Compare that against what they think I should be doing. So I've been jumping here and there everywhere, and also like they do not know what to give me to do, what direction to go for. But I think the main question I want to ask actually, do you have any advice on how actually I can help my parents' relationship or my mom's to help my mom be more happy? So my dad loves the business, but my mom is the one that is very negative and very always upset with minor things. And it's starting to get worse. I can see in my father, and he's thinking of selling the business simply just to save the relationship. So I really want to help. I really don't know what to do, so I'd like to ask you for advice.
It's a great question, brother. Probably, with very little context, probably the real answer is that your mom needs to go to therapy and understand herself better and understand why she's taking small things like work and causing it into unhappiness. I think a lot of kids don't think that they can get their parents into therapy, but that's because they said no before they tried for a year or two. When you have a parent that needs therapy, a kid is so affected by that they don't see a path of how they could ever get their parent to therapy. But in reality, one of the few people on earth that can get a parent to go to therapy is a kid. It's either a kid or a spouse, a sibling or a parent, occasionally a super best friend, but like it's hard. But a kid has the potential, and so I think that that's what you should try to do, because that's really the only answer.
The key thing that you said was try for 1 or 2 years.
That's right.
And 1 or 2
You
years.
got to try. You got to make it a big deal. You got to put pressure. What's going to happen in that scenario is when you're putting pressure on the parent, they're going to lash back out if they don't want to do it.
Yeah.
You've just got to outpatient them, and you've got to make them realize that you love them so much that you're not going to let this go.
I see.
And that's why the 1 to 2 year thing matters, because eventually they're going to understand you're not dropping this, and then it becomes a different thing, and that thing is true pressure from someone you love, and then you start questioning yourself, and then oftentimes you'll make that jump to save the relationship with your child.
Okay.
When
I've been saying no for my mom.
You've been saying no for your mom. That's right, brother. I'm so proud of you. That's 100% right. And by the way, easy for us to say a year or two in this call. Wait till you start trying for 3 weeks. You're going to feel drained. 3 weeks, not 104 weeks. And so, but it's worth it. It's worth it.
And I love my parents. I want them to be together and work together and find a solution to this.
It's getting your mom to do deeper work to figure out what's driving her darkness, which could be pessimism, cynicism, fear, anger, judgment, resentment, hurt. We have to help the ones we love put light on their dark.
Yep. Got a lot of work for me to do for the next 1 to 2 years.
100%, but it'll be the best work you ever do.
Yep. It'll be worth it. I believe so.
Me too.
What's up? You just want to run Resurgence duos, or would you rather run Resurgence quads? What the fuck is Resurgence quads? Quads. What are you talking about? There's a gift pack in the store that's free. The fuck? Stupid. It's just a stupid free gift pack in the store.
Holding for deployment. Take this time to warm up.
We have our last extravaganza up in Fort Collins. They pretty much throw a wedding for you without the ceremony part, so all the appetizers and the vendors and they feed you like they would at a normal, you know, wedding and stuff like that, but you get to try all their shit, and yeah, it's pretty cool. Last time it was awesome. So we're gonna head up there around 11:30 and grab some lunch. We got a meeting with a florist. Yeah. So just florist. So we're using a florist just for the boutonnieres and the bridesmaids and the bride bouquets. Yeah, I am too, a little bit.
Survive and your team can redeploy. Eliminate targets to bring them back faster.
I'm going to them. Huh. I am a little laggy, so I wonder if it's the game or if it's your shit. Mysterious item. What the fuck? I just picked up something that says mysterious item. Fucking weird.
Primary objective complete. All targets eliminated. Hostile counter UAV is active. Hostile UAV in this sector. Hostile counter UAV overhead. Bajnia, hostiles deployed the counter UAV.
Oh, it's...
Movement. Gas is moving. Hostile UAV in the area.
Where at? Okay.
Your team is in the safe zone. Hostile UAV active. Creatures are stirring. Threats in the area. Enemy dropping into the AO. Got movement here. The enemy lost track of you. You're safe. Enemy in the area. Enemy movement. Eyes up. The sector's hot. Hostile counter UAV is active. Need mid-call rounds. Hostiles in this area. Enemy soldier incoming.
Damn, I'm out of fucking ammo. Does he have any heavy? I just need some to get me. What the fuck is this dude doing, dude?
Locate their uplink stations and secure their intel before they go offline.
Enemy on the move.
Found him.
Movement. Enemy dropping into the AO.
Oh! Fucking pluck me. I don't know what I gotta do right here. I'm reviving myself.
Stay with me.
Let's take that most wanted. Enemy move moving. Cancel last.
Yeah, I got a shield. Oh, he's on top of it right here? Oh, he fucked me up so bad. There's 3 of them. Get out of there.
Marking your dog tag. Move to resecure it.
These teammates are terrible. One's in a helicopter. Who knows where the other one's at?
Sniper KIA.
station marked. Our UAV is orbiting the area. Gas is inbound. What's the vehicle here? Some of your team is still outside the safe zone.
Downstairs right now. I'm shielding when I'm coming up. We have a buy here too if you need to.
Squad mate protected. Contract complete. Hostile dropping into the area. Watch the skies.
Okay. Okay.
The enemy locked us out of their network. You missed your chance.
Ooh, he's aiming at us through this window. We might want to fucking.
Hostile UAV active. Let's take that most wanted contract. Friendly counter UAV on station.
Yeah.
Left. Stay sharp out there. Your squad mate has been marked most wanted. Keep him covered. Friendly UAV online.
Oh. Oh. Hello.
Redeployment time reduced. Your squad mate's back on station. Good work. Resurgence is about to end.
You still there? Were you able to get him?
You're losing round. Enemy dropping into the AO.
I'm dipping. I have no ammo or anything to really help you too much.
Part of your team is outside the safe zone. Your squad mate survived. Contract complete. ATV marked.
Armor box here.
I got munitions. Here's a. Bro, I don't want you to get on your. These fucking.
Ammo here.
There's a ammo right outside this door.
Resurgence has been deactivated. This is the end game. Kill them all.
Tossing smoke grenade.
Can't take much more.
T'inquiète pas, you'll be okay.
I'm fading fast.
Requesting fire mission. Target marked.
Oh, fucking ran out of ammo.
Took her out. Hostiles moving.
10 remain. You're nearly done. Detective time. All bounty targets are down. Well done.
Fill your plates up.
Threats in the area. Enemy in the area. Got gas moving in.
Where is?
Move to the safe zone.
I'm hit. Stun incoming. Take much more. Armor plate here.
Made it to the top 5. Good work. Gas is inbound.
I'm getting lit up.
Oh, how did you get behind me?
Check weapons and gear. We're holding for deployment. Enough training. Now we face the enemy for real.
So close.
Survive to redeploy fallen teammates. Kill to bring them back faster.
look. I did not look. They were good actually.
Bounty target identified. You are clear to engage.
Marksman rifle here. Leave it for me. Moving to my mark.
Yeah, I'm almost ready for the buy. That's what I'm trying to do right now. I got enough cash. There's a lot of snipers around here. Here's another MCPR. Ammo next to it.
All targets are KIA.
Oof, another fucking sniper. Alright, I'm heading up to you.
Hostile UAV in this sector. Moving here.
Fuck, I hate those people.
Hostile UAV
You got it.
overhead.
Gas is moving in.
Well, he fucking deserves that. Why didn't I just buy a fucking durable? What? Where at?
Friendly mortar strike on the way.
Be advised, you have teammates outside the safe zone. You have reinforcements inbound. Enemy movement spotted.
Okay. Oh, there's people way over there too.
Moving to my mark.
He's right here. Marked him. Ooh, I'm getting fucking plucked from somewhere. Oh, he's in the window. He's in the window. Oh, he's on top. Oh, I froze. Oh.
Got one. Be advised, enemy operators are tracking your location. Be advised, we're picking up signals from enemy uplink stations in the area. Locate them and secure their intel before they go dark.
Up on the mountain now.
Bosnia, hostiles deploy the counter UAV.
Enemy movement. Your squad mate is redeploying. Well done.
Got one.
Taking effective fire.
These guys are just up there, yeah. I'm moving left. Try to get a little better.
Hostiles on the move.
Downed him on the roof. Oh, he's right fucking here. Oh, fit. Down him. Oh, nice. He finished.
Hostile counter UAV is active.
Yeah, watch above us. I'm right with you.
Hostiles moving.
Your team made it to the safe zone. Hostile dropping into the area.
Target down.
Hostile UAV in this sector.
Where's this motherfucker?
Enemy here.
Bitch, try to come up on me like that. Oh, another guy. I'm plating.
You're safe. You lost the enemy tracker.
Oh. Look at that.
Enemy resecured their network. It's over.
Breaches are stirring.
Movement here.
That guy's fucked. Unless he goes downstairs, I guess. Oh! Oh! Behind me.
Enemy
Fuck
UAV
me
active.
up.
Hostile counter UAV overhead.
Enemy movement spotted.
Right here. Oh, fucking behind me now. Jesus. You good?
Watch your six. Resurgence window is ending.
Moving to my mark. Enemy on the move.
You're losing ground.
Yeah, they bailed.
I need high cal rounds.
You have reinforcements inbound.
Yeah.
Dropping
it is.
ammo.
That was clutch. I had 40 shots
Be
left.
advised. Part of your team is outside the safe zone. Enemy dropping into the AO. Movement.
No. Thank you.
Get that spotty.
Found an airstrike.
Jesus. There's armor right here.
Moving here.
No more second chances. 25 remain. Solid work so far.
Hostiles moving.
I'll be able to tap you. Where are you? He's in here.
Effective fire.
Friendly mortar strike inbound.
Just run.
Friendly airstrike on the way.
You're far from the safe zone. Advise you start moving.
Fucking killed one. He went all the way over there. Fuck. Fuck, I just dropped down.
Hostiles launched a mortar strike. Find cover.
Really?
Located your dog tag. Go get it back.
Where are you? Oh, he got you? Damn it. Oh, it's underground. Fuck. I could probably get you, actually. Wow. Two of them, though.
10 are left. Keep the pressure on. Gas is inbound.
Wow, what were the chances of that shit? I guess pretty good, but fuck.
Less than 10 were still standing. They hit us hard that time. But
Dude, that was one of our better games. I want to let me play that. Alright, I probably got 2 games left.
Cool.
Dude, you know the country star Morgan Wallen or Morgan Whalen, whatever? Fucking followed me on, whatever this thing is. What is this, TikTok? Yeah.
Enemy soldier
I don't know. I liked something that he created and then he followed me back.
X-ray down.
Yeah. Oh, there's no way this is his account. No, I don't think so.
Warm-up is over.
I
Stand
know.
by for deployment to the war zone.
Go to Ashika.
Stay alive to keep your squad in the fight. Hostiles dropping into the area. Watch the skies.
on me like that. There's one remotely close. Oh fuck, you got a lot. Yeah, coming. Oh. What was that? Oh, one of those vests? Yeah, I'm coming.
I'll take the armor satchel.
Okay.
Gas is closing in. This is enemy territory. Keep it tight.
Hostile counter UAV overhead.
Your team has entered the safe zone.
Oh. This buy's underground too. Don't know if I'm gonna drop down through this thing.
Hostile UAV in the sector. Hostile UAV active.
No. Be quick with it, you know. Alright, I'm going towards them.
Armor plate here.
Your squad mate's back on station. Good work.
The front of the... Oh, we got people here.
We've breached the enemy's network. Locate their uplink stations and download
Now I'm on
their
top of
intel
the building.
before they lock us out.
I'm healing. Selfing.
Hostile UAV overhead.
Okay. Yeah, I see you, I see you.
Still more fighting me.
Oh, they're sniping at us from the other building.
Gas is moving.
Yeah.
Squad mate is redeploying. Well done.
Moving here.
Some of your team is still
Moving
outside
to
the
my
safe
mark.
zone.
Oh,
Enemy
yeah.
movement.
Enemy soldier incoming.
Oh my god, dude. He is so fast with that. Can you grab me?
Got some dirt on it. You will live.
Oh, we got a dude on us. Bro. You wanna move to them? Got him. Got him.
Last uplink station is now offline. We've lost our chance at that
It's
intel.
up to them, I guess.
Our counter UAV is active.
Yeah.
Fire sale active. Buy station prices have been reduced.
Oh, fuck.
Gas mask here.
Yeah. Just a regular, though.
Hostile UAV in this sector. Breaches are stirring.
Enemy movement. Cancel last. Got movement.
Hostile UAV active. Friendly UAV on station.
Yeah, I'm coming down, moving down.
Window is about to close.
Oh, I just lagged hard. There's an ammo here, too. Refilling your ammo.
Enemy movement spotted.
Visual on the enemy.
Friendly UAV online.
Be advised, you have teammates outside the safe zone. Fire sales over. Adjusting prices.
Taking effective fire.
Remaining.
Enemy marked.
Moving up with them.
Our mortar strike is inbound.
Be advised, resurgence is no longer active. This is for keeps. Supply
Team
crates
wipe.
restocked. Load up.
Grid's marked. Send it.
This is Phoenix 2-3, visual on the target, strike inbound. No hits on that front.
Ah, he got me in here, boys. Fuck. Resurgence just closed too. Doing. No, I'm just gonna leave so we can do one more game. Fucking pew pewing lately though.
Warm up while you can. We will deploy soon. Practice is over. The real fight begins now. Enemy dropping into the AO.
Alright. I have no idea. Yeah. Yeah, hey, I'm down for that.
Survive to redeploy fallen teammates. Kill to bring them back fast.
At night or at 9? Oh damn. We have a squad. Yeah.
Enemy soldier incoming.
Nice, dude. Fuck them up.
All bounty targets.
Get him. Yeah. Oh, we got people right here. Got him. There's one more in there.
Enemy sniper here.
Nice.
I need high cal rounds.
Gas is closing in.
Bashня, hostiles deploying the counter UAV.
Enemy UAV overhead.
Yeah.
Gas mask here.
Advise you move to the safe zone now.
Grab some armor.
Good. I got munitions and armor. Oh, somebody on here? You just landed on here? I don't know how to get up. Yeah, I don't know how to get up there.
Setting mine. Something's incoming.
Wow.
Time's expired. Marking your dog.
Ah, he got me. Damn, he's serious.
Your squad mates back on station. Good work.
There's at least 3 of them. I'm gonna go over to the loadout.
You have reinforcements inbound.
Hostile UAV active. Hostile UAV overhead.
Be advised, we're picking up signals from enemy uplink stations in the area.
No?
Locate them and secure their intel before they go dark.
Hostile airstrike incoming.
Yeah, I'm coming. Stupid.
You're being tracked by an enemy squad. Evade and survive. Your squad mate is redeploying. Well done.
Coming back over to you. I don't think anybody's coming down here. Gonna move back up? I think we can over here.
Gas is inbound.
No, here's a different one over here. There's a gas mask too, if you need that.
Some of your team is still outside the safe
Fuck, I don't
zone.
have any either. Let's just stay down here.
Hostile UAV in this sector.
Upstairs.
station. Good work. Enemy dropping into the AO.
Oh, right here. Ah, you fucking... My dumbass, dude. That was my fault. Yeah, I shouldn't have hit. Shouldn't even shot.
The enemy resecured their network. It's over.
One of our dude has 14 damage.
Fire sale is active. Buy station prices are adjusted.
Like, what are you doing?
Oh yeah, buy station over here.
Ah, fucking armor box. Ammo box.
Marksman right UAV in this sector.
Gonna scavenge this place real quick.
Watch your six. Resurgence window is ending.
Our UAV is orbiting the area.
You got gas moving in.
Hostile UAV overhead.
Yeah, I got an armor box too.
Move to the safe zone.
Yeah, I'm looking. What do you need?
Fire sales done.
Come up to me.
Prices
Come
are
over
back
to me.
normal.
Friendly precision airstrike inbound. Moving here. Small caliber rounds here.
I'm good. I need sniper and heavy. I have enough right now. Oh, I'm coming in here. Staying in here.
Hostile UAV active.
Resurgence has closed. No more second chances.
He's right here.
Supply crates are restocked. Advise you load up now.
Hostile UAV
Yeah.
overhead. Thank me later. Hostiles moving. Moving to my mark. Hostile UAV active.
Good shot, dude.
25 are still active in the AO.
Moving up just a little bit to this building. Here's the gas mask.
Ammo depot here.
There you go.
You're losing ground.
This place has been ransacked.
Head to the safe zone now.
Yeah, what are they doing? I guess high ground's not a bad idea.
Hey,
have a lot of ground to cover.
I'm gonna die. I'm gonna die. Ah.
You're losing ground. Be advised, part of your team is outside the safe zone.
Rub some dirt on it, you will live.
Hostile dropping into the area. Watch the skies.
This other dude got me. Don't know. Damn, we did good. Unless they hit a buy, but I didn't hear it. How did we do? I want to watch. Yeah, we did good. All right, bro.